Welcome to Buy, Hold, Sell. My name's James Marley and I'm joined by Ben Rundle from NAOS and Alex Shevelev from Glennon. Today we're going to have a chat about the mining sector, particularly mining services, resources. At the start of the year, it's an area where you couldn't give away stock in a lot of those companies. 10 months down the track, it's been one of the best performing sectors on the market. It's actually been a tearaway success story. See if there's any value to be had in that sector still. Ben, I'll start with you. Did you think we were going to get this result? Turning back the clock to the start of the year, was it a place that you thought was going to be a sort of a deliverer of returns for 2016?
Yeah, look, I certainly underestimated it. I mean, I think, as we look at it today, a lot of the mining service companies have probably run a little bit too hard. If we look at where, commodity prices are, they've only really just moved, and that flow-on effect to the service guys does take a while. So margins are actually still in decline, but share prices have risen quite aggressively. So, for the large part, mining service companies probably look a little bit expensive, but in terms of whether we saw it coming, look, we're on a couple of them, didn't make enough out of them, got off too quickly, became too sceptical, and that cost us a little bit, but they've certainly done very well.
There's not a lot of value across the broader market, and this has been one of the bright shining lights. Alex, what's your take? Is it too late, or can people start? Is there still value to be had in this part of the world, in mining stocks, mining services? How are you approaching the sector?
I mean, looking at mining services, I think it's one that, you're right, was very, very deeply unloved at the start of the year, and the way in which it's come back has been very sharp. But I think it kind of reflects the margins of those companies. The fact that small levels of revenue increase can actually translate to relatively large amounts of increase for EBIT or EBITDA. Okay.
So what do we need to see for these companies to continue moving in the direction that they've been headed? And how do we see some of them sort of start to justify the valuations that Ben's touched on? What do we need to see happen across that industry?
Well, I think we need to see a driver other than gold as a starting point. So gold's been a very solid driver for a lot of these companies. Lithium's contributed somewhat, but what we really need to see is something else start to drive that, a return in activity somewhere else, or an increase in activity on the smaller size explorers that are able to then deploy capital.
Ben, the commodities across the board have all had a bit of a run back. They've definitely stabilised. Are we likely to see some more activity, exploration, production, those sorts of things? Are we going to see a sustainable uptick in activity to support some of these mining services companies?
Yeah, look, certainly for some parts of the commodity space, take coal for example, the price has really only run in the last couple of months. So in that space, you'd expect activity to significantly pick up while those prices are higher, so people can take advantage of the high prices. Gold's come back a little bit, but if you look at the Australian producers, they still make a pretty healthy margin. So I think while prices are high, certainly activity levels will start to pick up. We have seen order books look a little bit more healthy in recent times, but we really need to see some margin expansion to justify the share prices of some of these service companies. Okay,
and do you think that that's something that is likely ahead of us, or is the picture still too cloudy?
I think it's likely ahead of us, certainly in some commodities, but we really need to wait for that to come through. I think if you're really going to try and justify a significant increase in those share prices from here, I think for the large part, the easy money's probably been made, and from here you really need to see a significant increase in the order book volumes.
Okay. Putting a quality filter over the companies in the space, Alex, what are some of the things that we need to be looking for in some of these mining services companies? How do we start to filter them out and pull together an investable universe?
Yeah, well, I think one of the things that people were using to screen stocks out was the level of debt earlier in the year. And that's actually been quite interesting because in the last little while you've seen a lot of free cash flow generation from those businesses. So a lot of that, and some of those stocks were trading at very, very low prices to book or to potential future earnings. A lot of that has come back because free cash flow generation has actually been really strong. So I think one of the things you obviously look for are decent order books where they're supportive, decent margins from those order books so they're not doing business at low margins, and hopefully some semblance of the start of margin recovery.
Okay. Have you got a couple of examples of the sort of companies that you guys would pass your filters that sort of fall onto the radar?
Yeah, well, I think things like Macca, for example. Macca's been around for quite a long time, doing roughly the same thing over time, providing mining services to mines. Very, very simple work. They actually provide the digging equipment. They dig, they take dirt out of the ground, long-term contracts, new gear. it has been a tougher space, but they continue to do work. They continue to win new contracts.
Ben, you've got a couple of names, something in the mining services sector, something that looks like it's got a bit of it passes a few of the quality tests?
Yeah, I think Horizon for us, which is the rail operator throughout Queensland and the Hunter Valley, with coal prices picking up, that will significantly increase volumes. We've seen some transactions recently in Asiano, and there was an infrastructure consortium that took out Glencore's rail assets only last week for multiples significantly above where Horizon is trading. So I think you'll start to see volumes pick up, and we know there's M&A activity in the space which is at much higher EBITDA multiples.
Okay, just a final point before we move on. Commodity prices obviously have a huge impact on the outlook and the future prospects of a lot of these businesses. Have you got a general view as to how the commodity cycle plays out at the moment, where we are? What's the general thinking around commodity prices?
Commodity prices, look, I find difficult. There's a lot of commodities, I would be honest, and I couldn't tell you which way they're going. Coal's obviously had an extremely good run in the last couple of months, so the velocity of that move is probably done for now. An area we're focusing on is copper. We haven't really seen any pickup. The demand side of things hasn't really changed. There is still there's still an increase. There's still an oversupply in copper. But we did see Chinese import data turn positive for the first time in about 6 months. So maybe that's the start of things to come. But it's for us, it's a high quality commodity that hasn't really run yet. So that's where we're focusing our attention for the time being.
Alex, I'll finish with you. Is the worst behind us on the commodity front for now?
I think broadly it is, but some of the areas where people have made a lot of money in recent times, like lithium, for example, is at significant risk going forward. Because there, as with a lot of these things, as with rare earths before it, supply does eventually catch up in these kind of niche commodities, and it's definitely one to look out for.
Okay. Well, it sounds like the worst might be behind us when it comes to the commodity cycle, but you've got to be careful of a few of those hotspots.